All right, this is the August Investment Committee meeting. We have our full panel on the line. John Thur, our most senior member of the Investment Committee, Paul Meeks, Peter Nielsen, Dave Mariacker, Michael Zimmer, and Glenn Wiggle will be joining us. Let's start with you, John. What's going on in the market today? We've got a bit of a rally, I think, the past month or so, and we've seen a mixed earnings season, I think, but some strength. So what are you looking at from a buy side, and what are you looking at as far as positioning your portfolios for the next through the end of this quarter?
Well, I've been mostly selling into this rally, not buying. I'll buy on the dip, and I did buy on the first dip, but I'll buy more when it drops back down. I mean, I think you look at, we're really pressing hard to the top. We're at the 200-day, trying to poke through, not just on the index level, but a lot of individual names are right there. And a lot of them are near the oversold level on the RSI. So I'm expecting some kind of rollover here pretty soon. And it may not be till Labor Day, which is pretty soon. But I think, I wrote some stuff up for all of you guys, thinking I might not make this call, but I was fortunate enough to be able to make the call. But I think you know what I'm thinking. I think we're going to have more of an easier landing than a lot of people think out there. And I think the interest rates are probably going to peak at 3.5 at year end and then kind of cool off. And I think we could get some kind of a, compromise between slow growth and lower inflation, but not 2%. And that way you don't get a crash, you don't get a major recession, you don't control inflation totally, but I think you're going to get it to reverse itself. I think a lot of the talking heads over the last 4 months saying imminent recession is creating more of a slowdown than the interest rates themselves. It's more of a fear thing. People who are at the margin fearful of losing their job or changing their spending habits just as much as the tightening credit. You got the market oversold early on, like anything else. Projections for interest rates overdone to the upside. So you're getting normal corrections here and retracements. And then I think we'll have another leg down in the market, another leg up in interest rates. And I think we'll be doing this for a little bit. So that's kind of my take. And I think you trade around it, and I would still say don't chase anything and keep your risk level tight and just be patient.
Right. As a follow-up, you mentioned the word easy landing. By easy landing, explain what you mean there, because I think I know what you mean, but for those listening.
Sure. I don't think we're going to have a tremendous amount of layoffs. You're going to get some layoffs, no doubt. I think times like this, it's a great opportunity for businesses to clean house. You find out your employees that you couldn't afford to let go during a period of time when you can't find new employees. And this may be a time to let go of 5 or 10% of a workforce and replace them if you can. But I think if the business just slows down and you can afford to get rid of some people who are not productive, they'll do that. But I don't think you're going to see good people, strong employees get laid off in here. I don't think things are going to slow that much. Where I could be wrong is if Europe slows and we have severe problems with heating and the cost of fuel and in Europe over the winter, that's where I could be wrong. But as far as the US goes, I'm not looking for any major economic problem. Slowdown, yes. Maybe down to 2% to 3% growth instead of 5 or 6. But I don't think interest rates are going to get out of control. I think 3.5 is where the Fed said they're going. I think they're going to stick to that, and they'll be there by year end. And I don't think that's enough to hurt the economy. You've heard me talk that the interest rates are going to hurt the market and hard assets more than the economy.
Right. You beat me to my second follow-up, which was peaking 3.5% interest rates doesn't seem like a lot to me. That seems like we're going to stabilize here and allow room to run in the market in the future. Maybe not this year, but going forward in 2023 and beyond. Is that your take on what's going to happen if interest rates do peak at, which is a pretty low level to peak at, I think, knowing what they were talking about in the past year and a half, 2 years?
I agree with you, Dan, that peaking at 3.5 would be low if they stick to their goal of getting inflation down to 2%. And I don't mean, at the margin, I mean, literally 2%. But I do also think they're going to try to balance this. I don't think 3.5 will be a ticket for the stock market to go crazy and have multiple expansion, which we're already getting now, which I think we'll get a pullback from. But I think it'll be enough to keep the economy going at a reasonable rate. Inflation will still be going at a reasonable rate, and we're going to take time to grow into that in inflation with wage hikes, which I think can continue if the economy does well enough. But I think what you can't get confused is there should not be a premium in this market like there was at zero interest rates or falling interest rates. That premium needs to come out. Those PEs for the market need to get more. The market PE needs to stay more reasonable because there's going to be a lot of uncertainty over the next 6 to 18 months, in my opinion. And we're just going to get these fits and starts. And, I think you got to trade around it and keep massaging your portfolio. But
let's move to Paul Meeks. Paul, massaging portfolios is kind of your specialty. You like to massage things. What have you been doing in your portfolio on the buy side, or like John said, he's more on the sell side right now? Where are you at with regards to not just tech, but also general market consensus?
Yeah. So as far as what I've been doing in my portfolios is I'm definitely not selling, but I haven't been buying either. I have a little bit of remorse that I missed, some of this rally, but I'm just not convinced enough. I'm getting there after seeing a number of companies, Dan, announce, horrid results and horrid guidance in this most recent quarterly reporting cycle, and their stocks still rallied, which makes me think that investors are, okay, that's bad, short term, intermediate term, but long term, we're on the other side. And I think that might be a little bit premature. And so I expect to put some cash to work on a little bit of a pullback, but I still have a pretty big cash hoard. Now, particularly in the tech portfolios, where I think you've heard me say that even when tech comes back, and some tech stocks have already taken a pretty nice bounce off the bottom, that I think we're going to be in a fairly lengthy period where valuation matters. Of course, valuation doesn't matter when money is free. But I do remember from going through the internet bubble when it popped in the early 2000s, is we had a long time before those darlings came back, right? Those companies that I call profitless prosperity, that they grow their revenues at all costs and never really seem to be concerned, nor are investors concerned if that translates to cash flow and earnings. So those stocks were out of favor for a long time. And I actually think that as a tech investor, when they come back, they won't come back as far, and we kind of have to reorient our thinking to some tech companies that are more cash flow generative, that have some valuation support versus, let's call them yesteryear skyrockets. So even my technology mix, the stocks that go in the portfolio are, somewhat changed. But, I am a little bit worried that the consensus seems to think that the Fed will turn around on a dime in about February of next and actually start to lower rates. I think after the Fed has tried so hard to reestablish its reputation as an inflation fighter, man, I agree with John. I think the Fed fund futures indicate that we get to 3.25, 3.5, maybe a bit more. But, and I concur, but I think they're going to be there for a while. When you see Fed funds futures, indicating that all of a sudden they're going to trigger a recession, which forces the Fed to actually start aggressively lowering rates. That seems to be the consensus. I don't get that. I don't see that, because the Fed would not go through all that and then turn around and risk their reputation again. So if this rally, Dan, is actually built on easy money coming a couple of months from now, I think that's wrong. So that's kind of how I view it on a micro and a macro perspective.
Great. I think we're all in agreement that why would the Fed reverse course? I mean, John said it best, and I agree with you guys as well. What's your trigger point though to follow up? You said there's, you're a little heavier cash right now. You're kind of waiting. We've seen the market kind of rally, or at least the growth stocks kind of rally off the bottom. What's the trigger point to buy then if they continue to go up? Like when do you
Great
go
question,
in?
Dan. So if an account came in now, I would probably not reestablish a 20% plus cash cushion. I'd probably be halfway there, just based on, not that I have a clearer crystal ball than anybody else, but just based on that maybe the bad news is priced in. I wanted to get through this earnings reporting season, and either the numbers weren't as bad as I thought for individual companies, or they were as bad as I thought, or worse than I thought, and stocks rallied anyway. So it gives me some comfort that people are looking to the other side. I've always felt that if we have a recession, it's going to be rather short and rather shallow. And that gives me some comfort that, maybe I should start putting some money back to work. But I'll probably wait for a down day. But I expect at long last, several weeks, several months for me to be a bit more aggressive.
And how's your favorite stock, Micron, doing?
Micron took a beating in its last quarter, and then they actually only 40 days later guided down again, and yet the stock rallied. So this is one of those, Dan, I think it's, I'm seeing to the other side.
Is it,
Investors are seeing to the other side. Paul Meeks may not necessarily be seeing the other side, but I still own it.
Yeah.
I probably, with a new account today, would not buy it. It would not be on my fresh money list. It's just on my hold list. I mean, I have absolute confidence in the long term.
Let's move on to Dave. It looks like Dave Mariacker has joined us. I know you were on, Dave, but now we can see you. Dave, paint us a picture of what's going on in the growth stock world, maybe one or two of your favorite stocks right now. And we've already talked about interest rates and where you see sort of see the market going in the next 6 months as we close out the year.
So, beginning of last year, I really was nervous about the NASDAQ, and rightly so. I somewhat made that same commentary at the beginning of this year as well. So we've experienced money fleeing all of those names, and it was persistent. Overall speaking, when Mike asked me what my opinion was, I had thought that we were 65 to 70% through what my colleagues here so eloquently describe. It's very difficult. There's so many things that have gone on, and I won't do that. But let's just call it whatever it is, a correction, a bear market, whatever. And it's been somewhat substantial. And so I thought we were 65% to 70% of our way through. I believe we're now about 80. And I'm now a little bit more convinced it's going to take about another year for us to be fully through it. And earnings reports, things like that, are mixed, maybe to slightly to the upside. Valuations are higher. And some emerging companies, and maybe not that's the right word, but companies that maybe we're familiar with, some have really done all right and are now rallying, and some have really gotten beaten and have not rallied. So, as we come out of it, you got to somewhat maybe pick the old winners you had, maybe some new, and maybe cut some of the ones that are faltering. Thank you.
Next, Peter Nielsen, your take on, I offer the same question. Any buying opportunities currently? I know you do some sector rotating in the momentum model that you run. Where have you seen sort of momentum head in the past month, because things change for you monthly?
Yeah. Well, so the momentum portfolio is still only invested in commodities at this point. But when I looked at the market, we've done a few studies. One of the studies earlier in the year was just looking at how growth and value stocks behaved in up and down markets. And, it's kind of as you'd expect. Growth stocks in a down market get hit a lot harder than value stocks. In up markets, value stocks don't climb as much as growth stocks, at least this year. one of the things we noticed was that there was a little bit of asymmetry to it, where value stocks didn't climb as much, when markets rallied as they did on the downside. They'd fall farther on the downside than they'd rally on the upside. And I'm not trying to explain it. That's just something we noticed, that's how the betas for value stocks behaved. And a lot of the second thing we notice is regressing stock performance to changes in long-term interest rates. We found that interest rates essentially were able to interest rates were good at explaining the declines and recent increases we've seen in the market. And the reason for that is this. The stocks are much more sensitive to the rate at which you discount earnings. So than they are to say changes in earnings. So the discount rate has an exponential impact on stock market values, and earnings adjustments only that's a linear adjustment. So we saw interest rates rise from about 1.5% in December to a high of 3.49%, I think, on June 16th. And that essentially coincided with the bottom of the stock market. So the higher the rate, the lower the value. And since that time, we've actually seen rates rally. And it's a reflection, I think, of, we have to acknowledge two things. One is the Fed owns the short end of the yield curve. They greatly influence rates on the short end. On the long end of the yield curve, there are other factors that influence yields. Expected inflation. So there's an inflation premium in the yield, economic growth, so forth. So what we've seen since about mid-June is a steady decline, roughly a steady decline, hasn't been a straight line, in longer term yields. And that's been coincident with the rally we've seen. Now, given that these growth stocks have a higher beta, they've really outperformed, and that's why we're discounting growth at a lower rate, and they're more sensitive to market, up markets than say a value stock. So here we are. We were down 20% for the year at one point. Now we're down 8%. So things look a lot different at this point. No, in general, I would say I'm a little more encouraged than, say, my colleagues are.
Okay, great. Follow up though, back to the momentum portfolio. You said just invested in commodities. Is there a trigger point to get more fully invested? I mean, we're like you just said, we're off a bottom. Interest rates hit a peak, and now they've lowered a little bit, not a lot, but a little bit maybe on the longer end. And how do we get back invested in that portfolio? At what point do you go more fully invested?
Yeah, so the rule is the current asset price or asset class price has to be above the 10-month moving average, roughly the 200-day moving average. And we're getting close to that. So there's a good chance that we'll see more cash invested in this portfolio if those signals get tripped here as we come into September.
Okay, great. Mike Zimmer, can you tell us a little bit about what's going on in our strategic mutual fund or ETF models? Maybe some recent performance or any changes that we've made in the past month or so since our last call?
Well, I don't think we covered on the last call, but we did end up changing out of our small and mid value fund. We did replace that. That was kind of underperforming for about a year, and that was on our radar for a little bit of a while here. Other than that, everything else is kind of average to above average. There's definitely some positions that were darlings in previous years that have definitely taken a little bit of a fall back. Not to say that they're struggling by any means, but they're not leading their categories like they were in past. So there's a couple of positions that are now on our watch list, especially in the large cap space. But I don't think that there's any point to really worry about them. They do have that solid track record, especially on a 3 to 5 year basis. It's just more of the recent terms that have been tougher for us. So we're going to continue to watch those and see if anything needs to happen. But as I mentioned, we did do a rebalance here a couple months ago. But as of right now, nothing's on the horizon. If we keep getting this rally, we might want to talk about doing another one here. But as of right now, everything else is pretty decently positioned.
Yeah, I would think if we get a shift in interest rates going the other way,
Mhm.
we may want to do a rebalance. From the retail side, Glenn Wiggle, I know you're working not only with reps, but also with individual clients. What have you seen from a, I guess let's talk about the individual client perspective. What have been the hot topics or the buttons that people are pushing, whether it be get me into a more risky portfolio or de-risk my portfolio, maybe a little too late. Where's new money been going as far as some of these models that we're all managing? What have you seen?
Yeah, I mean, it's a little bit of everything, really. I mean, to be honest with you, new money is kind of being scattered around depending on the client circumstances. Obviously, in our office, the biggest topic comes to politics, right? So a lot about the midterm elections, what's going on with Trump and the latest raid, and where our country is going with the inflation bill. The conversation for us oftentimes comes down to the political side, and fortunately for us, we're in a position where we're going to have some gridlock going forward. It looks like so. If the polls are right, November's going to roll around, before you know it. And if you get, the Republicans that take over either house, either the Senate or the House, you're going to have a level of gridlock that prevents the government from really moving anything forward, which I think is a positive. The negative, though, is that you still have a lot of these agencies that are making a lot of the rules, which is continuing to be an issue. Although you have, pretty positive, EPA ruling, back a few months. So, I think it's pretty telling when you can say when the government can't do anything, everybody's life improves economically, financially, freedom-wise. So I don't care at this point, politically, who's got what party's got what House, Senate, White House. I don't care as long as they can't get anything done, because ultimately I think the markets just simply do better. The regulations to me are the biggest part. The tax policy, not a big deal. There's going to be some tax increases, IRS agents, yada, yada. It's the regulatory environment that becomes a drag on the overall growth of the country. And that's a bigger fear for me going forward, is that, have we given up on the possibility of ever getting back to a 3.5% to 4% annualized GDP growth? Are we going to settle now with 2% forever? I don't know. If that's the new norm, then I think the new norm for stock market returns also have to follow suit. And maybe that's a conversation about setting expectations a little bit differently over the next 5 and 10 years, depending on where we are. Already, some of the, whether it be the CBO or all, these wizards of smart that analyze these types of policies in Washington. But, the inflation bill that they just passed is already expected to have up to a 0.1% drag on economic growth in this country over the next, so many years. So, and typically they're always way underestimating that. So you could expect probably, my thoughts are probably a couple tenths of a percent drag in economic growth, which might not seem like a lot. But if our normal is 2 to 2.5% growth, and we're dragging by 0.2, we're giving up 10% of our potential growth. And so if long-term stock market returns are 10%, maybe the new normal long-term might look like more like 9%. And so for me, when it comes to retail clients, a lot of it is really understanding where we're at in the market and trying to really set the right level of expectations, so there's not a disconnect with reality and really what's going on the ground. So, but ultimately, I think, because we do the risk homework and because we go through a lot of background, most of our clients are pretty well diversified and are pretty comfortable, staying the course. And a lot of our clients have been with us through now multiple market, fluctuations, right? We just went through COVID. We just went through a housing crisis and a tech wreck. And a lot of our clients have been with us for 20, 25 years. So they have, gone through some of the battles with us and understand that we always come out okay on the other side.
Well, just a follow-up, if we, you mentioned, if we're giving up some of the growth, right? We're giving up some of the GDP growth, which probably hurts, growth stocks the most, right? It hurts those stocks that are not earning money yet, that we have seen long-term potential growth in, whether it be, a Paul Meeks tech stock or something that we're looking at an all cap sort of momentum portfolio. Where would you then put clients' money? More value stocks? Would you put them into more international stocks? Maybe there's more growth overseas than we're seeing in the US, or more bonds, fixed income. What's your solution there?
Well, not fixed income, but I would definitely stay diversified. International for sure is an important piece. Dividends are going to play an ever increasing important role over this next decade for sure. I think dividends are and income from these stocks are going to be really, really important. You know, regardless of the current period, if you look back over history, income part of the dividend part of the equation has been a big part of the S&P returns. I just think over the next 10 years, it's even more important, or at least over the next 5. It doesn't mean that circumstances can't change, right? And that's why I stay diversified, because a new administration that really goes on a bent for deregulation could change the dynamic and increase, long-term growth. So I would still be a fan of having both value and growth in the portfolio. I would just adjust my expectations, understand that we're probably going to be in a little bit slower growth environment until we can change, some of the green energy and the focus and things that we're looking at. I mean, just 2 years ago, we were energy independent, 3 years ago. Suddenly now we're begging, countries that hate us for oil. It's seemingly, and I said this a while back, there are 2 ways to battle inflation and to fix the economic situation that we're in, right? You can affect supply or you can affect demand. Ideally, in a perfect world, you affect supply in a positive way, right? You incentivize suppliers to produce more goods to meet the demand, thereby reducing the imbalance between the supply and demand and lowering costs and lowering inflation. Unfortunately, this administration, as expected, has decided to go down a path of lowering demand. And we've seen that, in some cases, prices are already lowering demand, right? You looked at gas prices and demand for gas dropped 8 weeks going into 4th of July when those are normally times that it's peaking. And so demand just naturally, because of prices, is already starting to decline. But I feel as if the philosophy from Washington in general is, be prepared to do with less, be prepared to not have as much and to lower your demand and lower those expectations. I think it was Jen Psaki that actually said, lower your expectations. I don't think that's good. I think growing the pie and growing the economic, wealth and GDP of the country, I think as a rising tide lifts all boats. I think that benefits everybody. And I would love to see an administration look back and focus on stuff like that. But ultimately, I think these things will solve themselves. Gridlock again is a good thing. And I think, the free markets begin to, fix that supply and demand imbalance themselves. And you're already seeing it in some of the numbers with the inflation backing off a bit. And I think I agree with Mariacker, Dave, a little bit. I agree with all you guys a little bit. I think we're 75 to 80% past it. It doesn't mean we don't have bumps in the future. I think we do have those bumps, and you'll have those buying opportunities. But I think for the most part, the markets we're looking to try to price in how bad was the recession and inflation going to be. I think we kind of have that answer now. And I think that's why the market's starting to recover a little bit, because we have a little bit better understanding of where inflation is and where we're kind of going. So I'm optimistic, actually.
Well, I think since none of us are politicians, we can't affect policy. We just have to roll with the punches, right? And invest where we can make money. True capitalist, right? Right, Glenn?
Exactly.
Well, with that, I'd like to, again, thank John Thur, Peter Nielsen, Paul Meeks, Dave Mariacker, Mike Zimmer, and you, Glenn Wiggle, for, did I mention you, Paul? Paul Meeks? Yeah. For joining us today. Independent Solutions Wealth Management, our website, iswealthmanagement.com. And if you are a rep listening to this call, feel free to reach out to us. And if you're a client, hopefully you are happy with our money management. And if you need any questions, contact your rep. Our next investment committee call is October 26th. And that'll be a public facing economic update that we do twice annually. Again, thanks for coming out today. I appreciate it.